Which government agency is the architect of monetary policy? And in the United States, we call it the Fed. The general terminology is the central bank. So, right, if you go to other countries and you wanted to know, okay, who's the architect of monetary policy in Brazil or in Spain or in Yugoslavia or one of the other countries, it's not Yugoslavia anymore. Right, the answer to that question would be the central bank. Of course, they're going to have, like we call our central bank the Fed. In those different countries, there is a particular, name for the central bank. Okay, our central bank, the Fed, has a dual mandate as governed by Congress. A, to maintain price stability, prevent inflation from getting high. B, to promote economic growth. Over the entire history of our Fed, which starts in the early 1900s, A has normally been the more prominent goal. However, you could argue that since 2008, B has been the goal that has played a larger role in the Fed's policies. This will probably become obvious as this discussion here goes further. Historically, monetary policy theory was centered around the supply of money. It's not anymore, but I want to mention this because quite a few of you, in fact, might be familiar with this idea that the supply of money is a key macroeconomic variable. It's a key policy instrument of the Fed. This was because cash was king. If you go far enough back, there were no debit cards, there was no Apple Pay, and if you go a little further back, there weren't even credit cards. So, okay, if in the 1940s and the 1950s, if people went out to dinner, if they went to see a theatrical play, whatever they were doing, all those transactions were cash. They had to be. So cash was king. So the macroeconomic theory about the role that the Fed plays in the economy back at that time emphasized the supply of money. But as we've mentioned, things have changed. Interest rates starting from the 80s or so, from the early 80s, interest rates became the more preeminent monetary policy tool of the Fed. Not that the printing of money that the Fed does is completely irrelevant. It's still there. It always will be. It's just demoted in importance, that's all. But then the world changed in 2008 with the fall of Lehman Brothers, and there are other policies the Fed has been pursuing since then. I will refer to them as unconventional monetary policies. So the interest rate policy is conventional. These other things that we'll talk about are unconventional. Okay, staying with the conventional interest rate policy for a moment, let's talk about the mechanism by which it impacts the economy. So the Fed controls an overnight rate. I have a note there. It's technically called the Federal Funds Target Rate. If you're interested in that, how does it impact the economy? It's an overnight rate for their member institutions like B of A, like Union Bank. That's not quite the right name anymore. They were bought, but anyway, I think they're doing business as Union Bank. They can borrow money from the Fed overnight if they need to, and this is the overnight rate we're talking about. So you might wonder, well, how does this member institutions, how does this affect the macroeconomy? It does through something we call the term structure of interest rates. What is the idea behind the term structure of interest rates? That it says that there's a connection between short rates like this overnight rate and longer rates that have broader impact on the economy, like the mortgage rate, like a corporate bond rate. So the overall list of monetary policy tools I have here, there's conventional, there's unconventional. I do list for completeness, I guess, the money supply, but it's archaic, right? That was a conventional policy, but it's irrelevant now in our modern economy. The key one nowadays that's conventional is the short-term overnight rate that we talked about. Then we have the three unconventional policies, the first two of which our Fed is pursuing, the third of which our Fed is not pursuing. Let's talk about the unconventional policies a little bit more. So the quantitative easing is direct intervention into the longer-term fixed income markets, bringing down yields and bringing down the costs of borrowing for entities that borrow in those markets. The interest on excess reserves provides stability to a fragile banking system. Negative interest rates penalize those who save.